Tax deadlines aren't just for April. July 2026 brings a wave of critical business deadlines, retroactive refund opportunities, and new federal rules requiring immediate action. Ignoring these updates means risking automated IRS fines or missing out on thousands in pandemic-era refunds and tariff rollbacks. We're breaking down the exact dates your business needs to stay compliant this summer. Let's dive in. We have to start with the single most urgent high-dollar deadline on the horizon, July 10th, 2026. This is your absolute final window to recover cash under a landmark court victory known as Kwong versus United States. The U.S. Court of Federal Claims ruled that because the COVID-19 pandemic was a federally declared disaster, the IRS lacked the legal authority to assess automated late filing and late payment penalties between early 2020 and mid-2023. The court found that deadlines were technically paused during this disaster window, meaning those past returns were never legally late. This means tens of millions of individuals, small businesses, and corporations are entitled to a full refund or abatement of failure to file and failure to pay penalties, plus the accumulated interest. But hear me clearly, the IRS will not automatically mail you this check. Because the government is still actively fighting this ruling, tax professionals are urging everyone eligible to file a protective refund claim using IRS Form 843 on or before July 10th. This secures your legal right to the money before the statute of limitations locks you out permanently. Keep in mind, the Form 843 cannot be e-filed. It must be filled out on paper and sent via certified mail to your respective IRS service center to prove you hit the deadline. Pull your old tax transcripts this week and don't let the clock run out on your money. I'll have the link to the form in the description below. While that pandemic refund window is a rare one-time opportunity, business owners also have several fixed midsummer compliance dates to watch. First up is July 6th, 2026. The new OBBBA tax law restored something valuable. Under Section 174A, businesses can again immediately deduct domestic research and development costs. And here's the retroactive part. Eligible small businesses, those with $31 million or less in gross receipts, can apply that treatment backward to their 2022 through 2024 R&D costs by amending those returns. But the window to do it slams shut on July 6th. Now, if you also claimed the R&D credit under Section 41 in those years, there's a coordination step. Normally, pairing the deduction with the credit triggers a taxable income add-back, a messy chain reaction of pass-through state tax liabilities. The fix is a retroactive Section 280C election made in that same July 6th window, which eliminates the add-back entirely. I did a complete deep dive breakdown on how to execute this R&D refund strategy step by step in a previous video. I'll link it in the card right here and in the description below. Once you clear that July 6th threshold, our next major compliance targets arrive at the very end of the month, July 31st, 2026. This is a massive administrative date for employers. On this day, every business with employees must file IRS Form 941 to report their second quarter payroll taxes, Social Security contributions, and withheld income tax. July 31st is also the statutory deadline to file Form 5500 for calendar year employee benefit plans, such as your company's 401k program. Missing either of these can trigger severe automated penalties, so make sure your internal teams are fully prepared. Quick but important one if your business touches imports. The Supreme Court struck down the IEEPA-based emergency tariffs, and roughly $166 billion in collected duties was declared unlawful and refundable. To handle it, U.S. Customs and Border Protection opened a consolidated refund portal called CAPE. Here's the catch. Those filing windows aren't one fixed date, they're rolling, based on your specific import categories, and several China-sourced categories are hitting their expiration right around this quarter. If you were the importer of record on those shipments, don't treat this like a year-end task. Get your broker invoices organized now and check out my full tariff update video. Before wrapping up our federal coverage, we have an important infrastructure rollout happening on July 4th, 2026. While the Trump account portal has already been up, this is the first day you can actually contribute to the Trump account. If you have already pre-registered your children using IRS Form 4547, this is your green light to begin moving capital. As I introduced before, eligible children receive a one-time $1,000 pilot program seed deposit from the federal government. From there, parents and guardians can contribute up to $5,000 annually to grow tax-deferred and low-cost index funds until the minor turns 18. If you want to check out the details, such as seed money eligibility, or want to compare the Trump account to others like a 529 or a traditional UTMA, go check out the deep dive video I dropped in a card above or in the description below. Now let's shift our focus to the states. Because July 1st marks the official start of the fiscal year for 46 states, it triggers a cascade of localized compliance rules and structural tax changes you must account for. First, let's look at New York. Effective July 1st, New York City's highly discussed pied-à-terre tax, also known as the luxury property surcharge, officially activates its enforcement and tracking mechanisms. It targets non-primary residences, condos and co-ops assessed at $1 million or more, plus higher value 1 to 3 family homes. If you own a second home in NYC that isn't your primary residence, keep in mind that this tracking applies retroactively to tax obligations dating back to January 1st, 2026. If you're in Washington, effective July 1st, 2026, the top marginal estate tax rate returns to 20%, down from 35%. California is increasing the retailer license fees for selling cigarette and tobacco products. New Mexico is also increasing the cannabis excise tax rate. And the Vermont telephone personal property tax is repealed effective July 1st, 2026. Finally, Hawaii is enforcing a major state-level exception window for taxpayers seeking penalty and interest waivers from the state. Under local guidelines, taxpayers must file Form L-115 on or before July 20th, 2026. Now, don't forget about the tax holidays in July. A sales tax holiday is a temporary break from sales tax, a window when consumers don't have to pay sales tax on certain goods and services that are normally taxable. If you're in Alabama, Mississippi, New Mexico, Puerto Rico, Tennessee, or West Virginia, check exactly when your holiday period runs and which specific products qualify in your state. Utah will also kick off a gas tax holiday on July 1st. And if your state isn't one of these, it doesn't mean your state doesn't have a tax holiday. It might fall in another month. July and August are just the most popular, since that's back-to-school supply season. To wrap up, the ultimate takeaway here is that midsummer is a critical juncture for personal and business cash flow strategy. Remember, proactive compliance is the only thing standing between your business and massive automated fines. Sit down with your CPA, map out your dates, and get these forms filed before the clock runs out. If this mid-year tax change breakdown helped you protect your cash flow, hit that like button and subscribe to the channel for more direct finance-focused updates. Thanks for watching, and I'll see you in the next one.